welcome to Paisa Live. We have Mr. Anuj Bhargava with us, who is the Managing Director of Lightspeed. Hello and welcome to our show.
Thank you. Thank you. Thank you
You
for
know,
having
we
me.
thank you. We heard your interaction, and you have mentioned correct things. For example, you must diversify your capital. The founders must diversify their capital, and no debt is a permanent solution. So, would you like to elaborate on this term that no debt is a permanent solution?
Look, I mean, ultimately, I think that comment was more for early stage companies
Right.
that are perhaps not yet profitable. But as companies mature, you can obviously always have debt as a part of your capital structure going forward. But for early stage companies, they have to be very careful as to when they take on debt, how much they take on debt, and how they plan to pay off that debt.
Right.
And once you're generating cash flows, I think you can have debt as a part of your permanent capital structure.
So, is there any right time, or is the founder must evaluate the right time when they have to take the debt?
Yeah, I think it depends on your ultimate use case, but our advice to our portfolio companies is to take it when, say, you're close to break even, and ultimately able to service that debt with your organic cash flows, or if you have a decent amount of equity cushion, but you're looking to perhaps expand into a new project or a new geography, and you can sort of take on some additional capital to help you do that. Or if you have a specific M&A target in mind that may be cash flow positive and you need some debt to make the acquisition happen. I think those are the sort of various use cases that allow a company to take on debt. We always tell people to not take on debt when it's very early,
Correct.
when you don't have product market fit,
Right.
when you don't have a plan on how to pay it back, when you don't have your unit economics clear, and you're basically paying off debt from your existing capital.
You also spoke about the IPO market, that the companies who are going for IPO, they start taking debt at a very early stage or during the IPO. Do you think that's the right thing to do?
I think, look, IPO is actually a way to perhaps pay off some debt if you have already
Existing debt
already.
Right. Yeah.
I'd say that companies need to think very carefully with their advisors as to what their right capital structure should be at IPO. Public markets do not like companies that are over-levered, so you need to make sure that you have the right capital structure and perhaps use the IPO proceeds as a way to pay down some debt and have the right sort of split between equity and debt going forward.
Well, thank you so much, Anuj, for sharing all these insights and all this information.
Thank you. Thank you for
so
having me.
much.
Thank you.
Thank you.
Thank you.